Well, hello everyone. We've got issue 442 of African Energy. Had some very strong stories reflecting some of the trends going on at the moment, which are sharp. We had a wide-ranging piece on Ghana, focusing on the court battle between Eni and the local company Springfield Exploration and Production, which has won a ruling in Ghana over the revenues that can come from the Sankofa field. And of course, this fits into that wider Ghanaian context where there's quite significant government intervention. They like the idea of unitization, which after all worked in the Jubilee field for Tullow and Cosmos Energy. But it's an issue that's being forced along. And there's a lot of toing and froing, and it possibly doesn't give the kind of signals that international companies want to see. And there's a strong suspicion that this, although the ruling's been made in an Accra court, we'll actually see this going towards international arbitration or some other kind of issue. And it's an interesting issue because you've seen Ghana, like many other countries, facing up to the reality of international oil companies working out how they confront the energy transition. We had last month or so ExxonMobil deciding that it's not going to go ahead and stay in the country with the West Cape 3 points, which is actually a big issue because Exxon was looking to be the player that might force forward a lot of things. There is some activity. Tullow's been letting contracts for extensions to Jubilee, and there's still quite a lot of speculation about what happens to the Occidental stake that Oxy got from Anadarko and would like to sell. There are a few companies, Asian companies. Also, it's suspected, although they don't confirm it, Aden Heavy's vehicle Baru, who are interested. So there's quite a lot going on in Ghana. We've seen two major pieces of legislation heading towards becoming law. Nigeria's petroleum industry bill finally, after 2 decades, was approved by both houses of parliament. Needless to say, they both approved different documents and these need reconciling. But the major piece of Nigerian reform legislation has made an advance. The key now is whether it can be implemented. And in Algeria, the implementing degrees that have held up the 2019 revised hydrocarbons law coming into play look like coming forward. That is important legislation. The Algerians have been producing some figures. We had a very nice table where the Algerians presented what they say is their much more competitive outlook now. Wood Mackenzie put together that data. So that's important. But the other thing that's really important is the investment environment. And we caught up with the story of what had happened to the Rompco pipeline that takes gas from Mozambique into South Africa and is seen as a major piece of infrastructure that could be expanded. Now that was expected to be purchased by a private investor group, including the black empowerment player Rayatile and the big private equity fund manager AIIM. And they were going to pay around 4 billion rand. It goes up to 5.15 billion with contingencies. That's $375 million. But in fact, what markets feared happened, and the two governments, I suspect led by South Africa, decided they were going to preempt the deal. So now Rompco will belong to IGAS and CMG of Mozambique, 40% each, and Sasol keeps 20%. Do these companies, do these governments have the money to invest in this? It's a big issue. But there's other things squeezing investors at the moment, and in our usually very full power sector, Jon Marks wrote, in fact we ran it as the editorial view, a very thoughtful piece on on the glut of funds coming into the African electricity supply industry, but some of the issues around that. Perhaps Dan's here. Do you want to come and give us some more details on what this is all about?
Yes, so I mean, this is a long-running issue, but one which has perhaps come more to the fore in the last 2 years as opportunities in general, especially in generation, have started to dry up, and that's that interest rates in Africa have for a long time been underpriced as far as international bankers are concerned. If you compare rates to, say, Latin America, they've always been lower on a risk-adjusted basis. But this trend has started to go to be exacerbated. There's been more focus on investing in the energy sector, increasing energy access. More and more money has been coming in, and then also with the energy transition as well, there's more money looking for projects. But the number of projects, especially in generation, where financiers and IPPs and private investment is most likely to be, has dried up over the last couple of years. The 2020 was the worst year for new capacity online since 2008 in sub-Saharan Africa. 2019 was also a bad year. And this means that effectively there's an oversupply and an increasing oversupply of money. And at the same time, tenders and the move to renewables and tender processes that go with it have squeezed rates as companies have bid prices increasingly aggressively. And these companies are needing concessional funding. They're negotiating hard with lenders. And there's a general concern that this is resulting in an unsustainable situation. Projects that aren't particularly strong and they're not very robust should there be payment issues or other issues down the line. And especially some of the donors are talking amongst themselves about what they're going to do about it, whether they should slow the trend. So yeah, it's an interesting kind of slow burning issue.
It sounds so technical, but it is so important in an industry that still depends so much on that interface between commercial and donor finance, isn't it?
Yeah, I mean, there's always been an argument that and you can come down either side on it, that Africa's risk-adjusted returns are too low, and this means that it can't attract commercial funding, and this is why it's had to rely historically on niche funding and donor, effectively just donor and concessional funding or strategic funding, for example, from the Middle East and China. Now, whether you could argue that's still the case is an interesting question, because there's not enough projects to mean that they necessarily need more money. But I mean, I think the other side of that is why there aren't enough projects, and a lot of governments effectively having to almost turn away investment because their sectors are unable to sustain rigorous payment schedules to international financiers, even on a concessional basis, effectively because of the failure to reform effectively. So a whole load of issues kind of wrapped up into kind of a single number of the interest rate.
Well, it's a good read, and for anyone in that industry, something that's really worth looking at. You had another piece I just wanted to highlight that we've got in the issue that you wrote yourself, Dan, was you were looking at Namibia and the passage and the progress of their reforms, commercial reforms in the electricity supply. What do you think are the big takeaways out of that?
Well, I think it actually speaks a lot to the issues we were just talking about. Namibia is really leading the charge towards a more commercially driven sector, albeit a very, very small one. And it's not totally clear how it will work out. Vietnam Power's had more financial problems than it's had before in the last couple of years, but it shows you what potentially can be done when tariffs are effectively dealt with and effectively unbundled. And what's happened in Namibia is they introduced in 2019 the modified single buyer model, which allowed transmission customers, there's actually only around 20 of them, to buy 30% of their demand directly from IPPs. So they can sign PPAs with IPPs, there's no set procurement process, they can do basically whatever they want. They just have to register with the regulator. And they can do this because the way the tariff works means that they're only competing for the energy price. So distributors aren't concerned about it. NamPower isn't concerned about it. NamPower is still paid a set fee for being the supplier of last resort, for providing ancillary services. Distributors are still paid for maintaining the network, all the rest of it. And on the 1st of July, the second phase came in, which was to allow distribution customers with connected at 1 MVA plus, so large distribution customers, to also participate in the market. And at around the same time, Natura Energy announced that it had signed a strategic agreement with Globelec to develop an 81 megawatt solar PV plant. So we spoke to the managing director of Natura Energy. He's talking about signing 3 to 4 PPAs, both in Namibia and also over the Southern African power pool. And you can start to see how this solves so many of the issues in African power sectors. These not government guaranteed projects, they're large projects by Namibian standards, in fact by regional standards as an 81 megawatt solar PV. And lenders and financiers and investors are banking on the market itself, because there is a market with rules, with tariffs that make sense. And so you're starting to see quite large investors like Globelec look at it, and I think it's quite an important development.
It is, and another good read, and I liked, there's a very nice table you provided showing the list of potential customers and their levels of demand, and then how much has actually been licensed, which shows there's things going on, but there's more that could happen.
Yeah.
On the
and so just there's one final point, that also an interesting contrast with South Africa, where they've gone for a fully kind of allowing commercial and industrial sales up to 100 megawatts, but without any real process or any clear idea of what the impact will be for the grid and how to manage those impacts. So I think a very interesting kind of juxtaposition between the two policies.
It is indeed. So these are some of the highlights. There's a lot more in the book. I'm looking at the visuals as well. We have a detailed map of the Ghanaian upstream and wider infrastructure linked in with the lead story. There's a very nice map with the oil blocks and the disputed boundaries between Gabon and Equatorial Guinea, as that dispute comes around again, and we're going to see them in an arbitration court sometime in the International Court of Justice sometime soon. And as we leave at this podcast at African Energy, a lot of people have been putting a lot of energy into producing our new Nigeria Power Report, on which we'll have a webinar later this month. But there's a graph that I ran alongside the Petroleum Industry Bill article, and it shows just the historical trend of Nigeria's population and GDP per capita. And it shows how per capita GDP at current prices has gone up and down, so often reflecting the oil price, of course, slightly more stable when you take the GDP per capita at the constant 2010 prices, which of course were the indicator that when the economy was rebalanced in 2013, that it took it. But there's a red line running through this, which rises the highest of all. And I thought it was appropriate to put in running side by side with the things about the PIB, because why Nigeria needs the PIB is so that Africa's largest country can start be more transparent, that its revenues can be divided more fairly and less opaquely, that its premium industry still, with all the energy transitions, functions better. And that's why it's important, and it needs to deliver for that population. So I'm looking at this graph at the red line, and it starts in 1960, and that is the population was at 40 million, independence in 1960. We come to 2020, and we're looking at over 200 million people, a huge number. And the World Bank has calculated that if real action isn't done to improve the social indicators, that the number of Nigerians living below the poverty line could reach to 100 million by 2023, 50% of the population. And that really is the bottom line of why you need things like the PIB, why you need functioning electricity sectors, and why questions even around the interest rates that power companies are paying are actually critically important to get development and actually meet these extraordinary population demands. Anyway, we will be back with another issue of African Energy in a fortnight, and we'll be monitoring the industries and societies that we look at very closely as it goes along. So thank you, Dan. Thanks for Harry putting it together. And we will be with you soon.